Welcome to the Microcap Brief. Today, we're diving deep into a critical maneuver, often seen as a last resort, the reverse stock split. But we're not just talking about the mechanics. We're examining its role as a lifeline for companies fighting to keep their exchange listing. As we covered in our episode on delisting countdowns, falling below an exchange's minimum bid price triggers a critical compliance period. While both the NYSE and Nasdaq have this rule, it's most famously known as Nasdaq's $1 minimum bid price requirement, which comes with a standard 180-day period to regain compliance. For a struggling microcap, a reverse stock split becomes the primary tool to mechanically boost its share price back above that critical threshold. Think of it as a financial defibrillator. The company's share price has flatlined, and the reverse split is the emergency shock designed to get a heartbeat back on the monitor. But the critical question is always this: does it restart a healthy heart or just briefly jolt a failing one? Let's look at two common scenarios. First is the case of the temporary reprieve. Imagine a company, let's call it Company X, that receives a Nasdaq deficiency notice. It's trading at 60 cents a share. To fix this, they announce a 1-for-15 reverse split. Mechanically, it works. The stock opens the next day above $9. Compliance is achieved. But the underlying problems, a high cash burn and no clear path to profitability, were never addressed. The market sees through the cosmetic change. Within weeks, the stock begins a steady decline as the fundamental weakness of the business continues to erode investor confidence. 6 months later, the price is back below $1, and the company is facing delisting all over again. The defibrillator provided a jolt, but the patient's underlying condition was terminal. The lifeline period was wasted. Now, let's contrast that with the second scenario, the platform for recovery. Consider Company Y. They also receive a deficiency notice and execute a 1-for-8 reverse split. The price jumps from 70 cents to over $5. But here's the crucial difference. The reverse split was not a standalone event. It was one piece of a much larger, credible survival plan that was communicated transparently to shareholders. Concurrent with the split, Company Y announced a new strategic partnership that brought in cash. They detailed a significant restructuring plan that was already reducing their cash burn. They had a clear, funded roadmap for their product. In this case, the reverse split wasn't just a price fix, it was a necessary step to clean up the balance sheet and provide a stable platform for their real recovery plan to work. The defibrillator shock was followed by life-saving surgery. These scenarios highlight why a reverse split demands your intense scrutiny. It is never a solution in itself. It is only a stopgap. It fixes the symptom, the low share price, but does nothing to cure the disease of a weak business. The true test is what management does with the time they just bought. Is there a concrete, credible, and executing plan? Vague promises are a massive red flag. Your key takeaway is this: never view a reverse split and regain compliance as a victory. It is merely the starting gun for the real race. It's the ensuing period where management must prove they have a viable path forward. Your job is to look for the concrete actions of Company Y, not the temporary cosmetic fix of Company X. Your homework is to apply this framework. Before you ever consider investing in a microcap that has recently done a reverse split, dig deep. Read their latest filings. What triggered the low price? And what specific, measurable actions are they taking now to fix the real business? The lifeline only has value if the patient is actually recovering. Thank you for listening to the Microcap Brief. Stay vigilant, do your homework, and always do your own research.